For many foreign invested companies in Vietnam, accounting records appear organized on the surface. Monthly tax filings are submitted, invoices are issued, bank transactions are recorded, and management assumes everything is under control. But then the annual audit begins. Suddenly, auditors start asking difficult questions. Where is the supporting documentation? Why do certain transactions not match banking records? Why are payroll records inconsistent with labor declarations? Why are some expenses unsupported? And in more serious cases, auditors may refuse to accept parts of the company's financial records altogether. For many foreign investors in Vietnam, this becomes a shocking moment, because they assumed accounting compliance and audit readiness were the same thing. In reality, they are not. Many foreign business owners misunderstand the role of auditors in Vietnam. Auditors do not simply review numbers. Their responsibility is to assess whether the financial statements accurately reflect the company's operations and whether sufficient evidence exists to support the accounting treatment applied. This means auditors may examine invoices and contracts, bank transactions, payroll documentation, tax declarations, intercompany transactions, loan agreements, expense supporting records, and the consistency between operational activities and accounting entries. If the records cannot be properly substantiated, auditors may conclude that certain financial information is unreliable. And this can create serious consequences for foreign-owned companies operating in Vietnam. In Vietnam, auditors typically become concerned when accounting records contain inconsistencies, insufficient supporting documents, or unclear transaction purposes. For example, companies may record expenses without valid invoices. Payments may be processed through personal accounts. Cash transactions may lack supporting evidence, or accounting classifications may not align with actual business activities. Sometimes the issue is not intentional misconduct. The problem is simply weak compliance management. But from an auditor's perspective, unsupported or inconsistent records create risk. And auditors are professionally obligated to address that risk before issuing audited financial statements. This is why even small accounting weaknesses can become major audit concerns. One of the most common problems auditors encounter with FDI companies in Vietnam is accounting systems built only for monthly tax submission purposes. Some accounting providers focus narrowly on filing obligations without building a strong documentation structure behind the records. As long as tax reports are submitted, management assumes compliance is sufficient. But annual audits require something much deeper. Auditors need to verify whether the company's financial records are legally defensible and operationally reliable. If accounting entries cannot be supported by contracts, invoices, bank transfers, payroll evidence, or internal approvals, the records themselves may become questionable. This is particularly common among startups and SMEs that selected accounting providers primarily based on low cost. Imagine a foreign-owned technology company operating in Vietnam for several years. The company used an outsourced accounting provider to manage monthly compliance. Everything appeared normal. Taxes were filed, reports were submitted, operations continued smoothly, but during annual audit season, problems began appearing. Several marketing expenses lacked sufficient supporting documentation. Intercompany service payments were not clearly documented. Certain cash reimbursements could not be traced properly, and payroll records did not fully align with employment documentation. As auditors reviewed the records, management realized something important. The accounting system had been built for administrative filing, not for audit defensibility. The company then had to spend weeks reconstructing records, responding to audit concerns, and correcting historical accounting issues under significant pressure. For foreign investors in Vietnam, audit problems do not remain isolated accounting issues. Rejected or questionable financial records may affect tax inspections, profit repatriation, investor due diligence, banking relationships, licensing procedures, future fundraising, and even company valuation during acquisitions or expansion discussions. In some cases, unresolved audit concerns may increase the likelihood of regulatory scrutiny later. This is why strong accounting management is not simply about compliance. It is about protecting the long-term credibility and operational stability of the business itself. The most effective way to avoid audit problems in Vietnam is not waiting until audit season to organize compliance. Strong audit preparation begins throughout the year. Foreign-owned companies should maintain clear supporting documentation for major transactions. Bank records, invoices, contracts, payroll documents, and accounting entries should remain consistent and traceable. Management should also understand how transactions are being treated from both accounting and tax perspectives. Most importantly, foreign investors should work with accounting providers experienced in supporting FDI companies in Vietnam, not providers focused only on basic tax submission work. Because good accounting is not simply about filing reports. It is about building records capable of surviving professional review. Many foreign investors separate accounting from legal compliance. But in Vietnam, these areas are deeply interconnected. Weak accounting records may later create legal exposure during tax inspections, regulatory reviews, investment transactions, or shareholder disputes. This is why experienced foreign-owned companies increasingly coordinate accounting, audit, and legal oversight together. At LTS Law, we regularly help foreign investors assess compliance risks connected to accounting structures and audit preparation. Although LTS Law does not directly provide accounting or audit services, we help clients identify accounting and audit partners experienced in supporting foreign invested companies in Vietnam with stronger transparency, English communication capability, and FDI-focused compliance understanding. Many foreign investors assume their accounting is compliant because reports are submitted on time. But in Vietnam, the real question is whether the company's financial records can withstand professional scrutiny when it matters most. At LTS Law, we help foreign investors understand that sustainable compliance requires more than administrative filing. It requires proper structure, documentation discipline, and long-term risk management. If you are operating or planning to establish a foreign invested company in Vietnam and want guidance on accounting oversight, audit preparation, or selecting suitable accounting and audit partners, book a consultation with LTS Law. Because in Vietnam, the strength of your business is often measured by the strength of the records behind it.